I'm Jay Pitts, a real estate broker, agent, leader, and investor. For the last decade, I've navigated the craziest of real estate markets this country has ever seen, selling over 2,000 homes, moving in and out of markets, always ahead of the curve. And now I'm bringing that perspective to you. This is your resource, and Real Talk About Real Estate starts right now.
And we're back, folks. Welcome to another episode of Resource Real Talk About Louisville Real Estate. I am your host, Jay Pitts, broker owner at REMAX Premier Properties, leader of JT Pitts and Associates, among other things, and not always good, but I'll take it. Wear it as a badge of honor. Anyway, so hopefully you tuned in to last week's episode where I took my 40 lashes with a wet noodle for errant predictions in 2021. To be quite honest, I feel like it was pretty mild considering where I thought it might be when I made the predictions earlier in 2021. I actually think it was quite accurate. I don't know. I mean, maybe it's just, ego talking or what have you. But I think it was pretty accurate. I'm feeling pretty good about myself. Thank you for tuning in once again. Back this week, we're going to give you the 2022 predictions. And likewise, I'll commit to you to doing another episode about the same time next year where if I am wrong, I will allow you to tell me that I am wrong. It's one of the fun parts of starting a new year. We all know that, time as it relates to real estate production is just kind of an arbitrary thing. There's never a wrong time to do the right thing, or, it's always the right time to do the right thing. That being the week of MLK Day, we can cite the great Martin Luther King Jr. in one of his great quotes. It's always the right time to do the right thing. Hopefully I make some good predictions for you today. Before we get into that, let's remind you can find us online pretty much everywhere. You can find me on all the socials. You can find the podcast here everywhere you podcast, regardless. I mean, some of the most obscure places where you will find audio content, you will find us. Specifically, we would love your patronage in two places. Apple Podcasts, where we would love it if you give us 5-star reviews, only 5 stars. 4 will be resent for correction. 5 stars only. Give us a follow. That is what they call it now. It's a follow. It's a little plus sign on your Apple Podcasts app or Spotify. Those are the two places where most people are. The algorithm gods appreciate you showing them what you like and therefore will reward us by serving the podcast to more people. We're not advertisers, but we don't monetize the podcast. We are real estate professionals. We do this because we love it, because we like spreading the love. We like helping, and we're trying to increase the size of our circle. But, anything worth doing is worth doing right. So let's get this in front of as many people as possible, both in video and audio form. Speaking of video, you can find us on youtube.com/jpittsrealtor. There's a channel for resource right there. Very easy to find all of our content. Full-length episodes can be found there. You can find us on Facebook at The Resource Podcast. So facebook.com/The Resource Podcast. You can find me on Twitter at JTPA Louisville. That stands for JT Pitts and Associates at JTPA Louisville. You can find me on both. Let's see. You can find me on Instagram at JPittsRealtor. You can find me on TikTok at J_Pitts. And don't forget about our sister piece of content, JTP University. We'll be back with new episodes on that real soon. All right. Now that the bills are paid, let's move on to my predictions. You could be watching live, which is not something I didn't mention. We do have a live Facebook group opportunity to watch the podcast here around lunch on Wednesday every week. If you're watching live, feel free to give me comments. Happy to hear your reactions in real time. But I'm going to keep it pretty similar to what we did last year. I think that is a recognition of the fact that certain metrics play a very real impact on the real estate industry, specifically the real estate industry here in Louisville and both nationally as well. There's a reason for that. Okay, I'm going to talk to you about some financial metrics, some things that you don't necessarily think of when you think of real estate market. Most people tend to go on feeling. I would tell you not to ignore your feelings, but also find some facts. That's something you'll hear in the in the sphere out there somewhere where facts don't care about your feelings, that kind of thing. Feelings and facts matter in this game. I really, really enjoy, getting an understanding of where the market is, basically trying to figure out where the market is based on my own experience, based on my agent's experience, but I also like hearing the facts. The facts of any situation are backed up in statistics and models, and we can point to some of that here today. Okay, so with that understood, let's move on to prediction number 1. Prediction number 1 for this year is about the Louisville market as a whole. The Louisville market, I predicted last year would drop around 700 units. Around 700 sales units, homes sold, 700 decrease. It was nearly 1,000 decrease, nearly 1,000. We did 18,790 units in 2020. I predicted 18,180, a reduction of roughly 700. We actually got 17,228 units. I predicted $5 billion, an increase from 4.7 in 2020. We actually got 4.85, not quite there, but an increase nonetheless. I predicted an increase of from 251,000 in 2020 average sales price to 275. We got an actual increase of 281. There's your recap on 2021 predictions. My 2022 is very similar. Very similar. I'm going to project a decrease in units once again. Okay, once again of about 4%. 16,665 units, representing, a tapering of demand. A tapering of demand. Our demand has peaked in 2020 in terms of units. That was probably brought forward by the coronavirus pandemic that we did not see coming. Okay, when we rolled the calendars from 19 to 20. You're going to see that we have borrowed forward units that would have been spread out over a multitude of years. We've borrowed units forward because of reduced interest rates. We've borrowed units forward because of the expectation of price increases, which we actually had. 16,665 units, a representation of 4% decrease over 2021, market down. That's my prediction. I'm also going to stick with my $5 billion in sales volume prediction from last year, which would represent another 3% increase. $5 billion in sales. We didn't get there quite there last year. With another 600 and some odd units getting sucked out of the market, it's going to be really hard to increase the sales volume total to $5 billion. I think we're going to do it. You may be telling yourself, okay, that means prices are going up, Jay. How much? How much? I'm going to predict from 281,000 was where we finished 2021. Average sales price. We're going to 300,000, a 6% increase. 6%. Jay, that's way less than economists are saying we're going to see in terms of price appreciation for 2022. Well, number one, I don't know that I've heard any real predictions of late. I don't think I have. Okay, I heard 13% summer of 2021. 13%. Turns out we got 2021. We got roughly 13, maybe 14%, close to 15% price appreciation here in Louisville. I don't think we're going to get that again. There's signs of weakness in the economy, receding demand, okay, shortage of supply. We're going to get into that more here in a moment. But I don't expect to see double-digit price increases. I don't think there's going to be enough demand. I don't think there's going to be enough supply. Inflation has taken hold. We're going to be combating that from a national fiscal policy standpoint in an election year, okay? And the air's just out of the balloon a little bit. Okay, I don't mean that there's going to be a bad market. Told my team on Monday, you can increase production in spite of a receding market with efficiency. Get more share. Get more share of the market. Okay, let's recap. 16,665 units, or a 4% decrease in the market. $5 billion in total sales volume, or a 3% increase, which brings us to an average of 300K, up from 281, or a 6% increase in average sales price or price appreciation. Let's move on to number two. Number two, REMAX Premier Properties, my firm. We made this prediction last year. You know, it's my show. I get to make the rules, which means I get to talk about my company. I hope you're tuning in because you like what I have to say. Hopefully you're not tuning in like one of those scenarios where you just like to follow the people that you don't like and hear what they say. I don't understand that, Patrick. People watch cable news for this reason and a lot of reasons. Like you're on either the red team or the blue team or the right team or the left team, and you watch the other people's media to make yourself angry so that you can hate them more. I hope that's not the case. I really don't. I hope you listen to the show because you enjoy what I have to say. And, what I'll tell you is we had a banner year in 2021. 1,628 units for $405 million in production. That represented a massive increase. Get back to my notes, I'll tell you. It was predicted by me that we would go to 1,000 units for $275 million. That's up from 942 sales for $216 million in 2020. We went from 942 to 1,628. We went from $216 million to $405 million. Pretty substantial increase. I'm here to tell you that I'm going to predict a further increase to 1,800 units. 1,800 units is a pretty, I think, modest increase. I mean, that's less than 10%. I'm going to say also that we go, because we have lagged the market average sales price by a little bit the last few years. I predicted last year that we would get on pace with the market average sales price. I don't think we're going to do that this year. I think we're going to get to $500 million, that $500 million, kind of high bar to catch. But I think we're going to eclipse that. And those 1,800 units, okay, and that $500 million would represent a 10% share of market in both, or north of 10% share of market in the units column, because I'm predicting 16,665. 1,800 is slightly north of 10% there, but it's spot on a 10% share of the volume market, which volume is what really matters because we get paid in percentages as real estate agents here. And it also runs us out at about a $275,000 average sales price. So we lag the market by $25K. It's about where we've been for the last few years. So once again, 1,800 units, $500 million, average of $275, 10% share of market, which is phenomenal considering our 80 some odd agents, which will probably grow to 100, roughly 5,000 agents. So that's 0.5% of the agents doing 10% of the business. I think I did that math correctly. Let's just say 100 into 5,000. It's 2% of the agents. 2% of the agents doing 10% of the market. Okay, that's a 5x share on your average agent. Book it, mark it down. I'm writing 5x in big, bold, capital letters so that when I look back at this time next year, I remember that was my prediction. Some of you may not like it. Well, that's the prediction anyway. All right, number 3. Moving on to interest rates. I think this is going to be a big topic of conversation this year. Wasn't so much because they had been so low for so long, and we're starting to see the opposite, the trend reverse. I think it's going to be a big topic of conversation. So as a reminder, okay, we closed the year at 3.22%, okay, of 2021. 3.22%. My predictions from last year. Okay, so let's do a little recap. Rates ended the year of 2019 at 3.72. I predicted 2.67. Okay, 2.67. And oh wait, hold on. I'm messing my numbers up here. I'm looking at the wrong thing. Where am I at? Rates ended the year of 2019 at 3.72. Okay, they were 2.67 in January of 21. I predicted 2.5 by the end of the year, and we ended at 3.22. It was probably one of my most inaccurate predictions of the year. 3.22 rates are currently sitting at 3.45%. This is the Freddie Mac index for 30-year fixed-rate mortgages. It's most indicative of where rates are going on residential housing. Okay, 3.45. I am going to predict in 2022 rates will finish north of 4%. They are going to flirt with 4.25% at some point. May even make it there. some point during the year of 2022, testing a ceiling at 4.25 and how much the market will tolerate that sort of increase, but ultimately finish the year around 4% or about a 0.55 increase, a little north of half of a point increase from today, a little north of 0.8% or a little south of 0.8% increase on the year. Now, a little more color to that conversation. A little more color. The Fed has signaled in recent weeks 4 federal funds rate hikes. Discount, overnight rate, whatever you want to call it. The rates at which banks borrow money between one another. 4 hikes. This is a result of the inflation that we have seen in the market. Record highs in consumer and producer inflations, year over year increase, records, things that they didn't even see in the late 70s, early 80s. They need to get inflation under control. They have signaled 4. 3 months prior, they signaled 3. So we've already gone from 3 to 4. The increase from 3.22 at the end of the year to 3.45 today is a shock in the market, with the Fed changing course from not just 3 hikes expected, but 4. I'm going to predict to you today that they actually end up doing 5 hikes, okay? Because inflation continues to prove to be more out of control than expected, and they have to get it under control. It's a long lesson, and probably something that I'll never dive into on this podcast, as to why interest rate increases rein in inflation, okay? But that is the chief mechanism that the Fed has to control inflationary policy, inflationary circumstance. 5 hikes, not 4. North of 4%, testing 4.25, receding down, ending the year at 4%. Rubber stamp it. It's on the record. Number 4, a little different than last year, absorption rate. And this is from a few weeks. I was talking to my agents for months leading up to the close of 2021 about the need for higher performance in terms of listings coming to market to close out the year, so that we found ourselves in a better place in 2022 than we did in 2021. Now, that didn't necessarily happen. I don't know if it was fatigue, again, if we were borrowing sales and listings forward, if the market had enticed people to, get in the marketplace sooner rather than later. We just didn't see it, right? Inventory trailed off toward the end of the year, as it does traditionally, from a seasonal perspective. We did not see a better than average fourth quarter in terms of listings to market. Sales were great, but sales further take units out of the market. So now let's consider where we stand. Right now, 2 weeks into 2022, we are 82 listings to market behind. Excuse me. That is cumulative. We are 169 listings behind. The 2 weeks, the first 10 days, we were behind 108. The second, we were in the 80s. So, point being, we're behind where we were this time last year in terms of inventory, and last year we had really, really slight inventory, not enough to adequately move buyers to contract on suitable properties that resulted in closings, and a lot of consequences came as a result. If you compare this to 2020 and 2019, we're even further behind those years because inventory was more plentiful in those years, albeit very short. It was still very plentiful compared to this year. This is the worst we've seen the first 2 weeks in January in the last 4 years. So what that means that the current 1.14 months of supply, or the absorption rate of 1.14, and I should be clear, this was the average for 2021. The average for 2020 was 1.84 months. That's about a 40% decrease in available inventory to sell. That absorption rate will fall as low as 0.75%. of 1 month. 3/4 of a month supply. Okay, once again, absorption rate is how long it would take at the current rate of sale for every home in the market to be sold. Okay, does not take into account, it indirectly takes into account new listings to market, because new listings on the market and the rate of sale does not change. That absorption rate grows. As I said, 1.84 months average for 2020, 1.14 months average for 2021. We're starting off with the slowest January we've had in 3 or 4 years with respect to inventory coming to the market, listings hitting the market. That's going to fall as low as 3/4 of 1 month. For perspective, a balanced market is 6 months of supply. A 3-month supply was the new normal from 16 to 19. In 2020, we fell to 1.5 at its lowest. 1.5, and the average was 1.84 months. We got down around 1 in 2021, and then it, kind of oscillated, back and forth in the low ones, okay, and ended up averaging 1.14 on the year. It's going to go below a month. It's going to be the busiest market you've ever seen for the buyers that are out there in certain price points. But demand will recede somewhat. Inflation will take, and higher interest rates will take some people out of the market. So as the year progresses, it will feel less hectic. Okay, still busy, but probably less hectic than peak 2021 traffic. Less sub 1 month supply. In fact, 3/4 of a month, mark it down. That's prediction number 4. Number 5, the Dow Jones Industrial Average will hover in the 35K range, closing the year roughly the same place it started. Currently, we're at 35.4. The economy is usually juiced in an election year. Midterm elections are coming up in November. We're 2 years into the Biden presidency. He sure would like to hold both houses of Congress. There tends to be one flip historically at the midterm. Either the House or the Senate should flip if historical reference holds true. The better the economy, the more likely the Democrats are to hold both houses of Congress. However, the agenda is so well publicized of this administration, I find it hard to believe. The only way to juice the economy right now is to inject more cash, which is inflationary. Inflation has proven to be a big issue. They're trying to rein it in. We're trying to go the other way. So no longer would you likely see the federal government have success at injecting cash into the marketplace. Okay, more than likely they're going to be drawing cash out with higher rates. Okay, stabilizing inflation. Okay, hopefully getting that under control. My guess is the Dow stays very flat, 35K. But that's not the full prediction. I have been known to pick a few other stocks or securities or what have you. My favorite, you guys know my favorites. Bitcoin. 42.2 as we sit now. I forget what my prediction was for last year. Let's see. I had a pretty intricate one. I said it would close north of 40 and go as low as 28. That was a 10% decrease, 20% decrease. I don't remember exactly what it was. Ultimately, it closed at 43.7, so we're pretty flat now. It's down a little bit. It went as low as 28.8. I'm not going to do that this year. I'm just going to say a big, bold prediction, I believe. Bitcoin will close the year north of 70K. Inflation and election year divisiveness, despite the Fed reining in inflation, will drive demand for Bitcoin, which will drive the price north of 70K. Number 3, Tesla. Had a pretty intricate intricate. I predicted that the Tesla Cybertruck would be in my driveway by the end of 21. They have now pushed the start of production into 23, so I can't make that prediction again because the year will be over. So I'm just going to say that from 1023 currently, Tesla stock will close the year over 1,300 for a near 30% increase. I just think there's nobody doing EVs the way they are. It's pretty hard if you've ever driven one. Okay, which more and more people are gaining access to that experience. It's hard to compare it to anything you've ever experienced. It is instant acceleration. It's like being on the rock and roller coaster at Disney World, Patrick, and they literally shoot you out of a cannon. You're 0 to 60 in like 2 seconds. It's crazy. So north, and it drives 300 miles, and it doesn't use gas, and it doesn't pollute, and global warming, and the whole thing, right? I'm not a scientist, so I don't understand those things, but I can tell you it's a priority for a lot of people, and despite what I'm told with electric, the production of electricity polluting more than, the burning of fossil fuels in automobiles, I think that's scalable technology that will get pollution under control. EVs are the future. Nobody does it better than Tesla. Hard to say with your lifestyle in the United States that a vehicle doesn't have such an impact that it can drive a stock price 25 to 30% increase year over year in a year that will probably be the biggest year in history for EVs. I think it's a near 30% increase. All right, this would be number 6. I'm going to call it a bonus because I only do 5. Bonus prediction. Okay, relating to the real estate market. New construction is back. I know we've had a recent increase in lumber cost, rivaling the increases we saw, late 21, or late 20, Q3, Q4 of 20. I know prices had stabilized, and now they've jumped back up 20, 30%. I'm going to say that new construction, 2020, I've been saying it a while, but 22 will mark the year that new construction shows up for the first time since probably 2006 as a real market force in residential housing. Specifically, that will be marked by our real estate transactions. Remember, I said earlier in the episode, 16,665. For 2021, we did 1,620 new construction deals, roughly 9%. That's going to go to 2,500 or north of 15% for the coming year. 2,500 or 15% of the market will be new construction in 2022. If you're not paying attention, if you don't know builders, if you don't know how to search for land, if you don't know where the new developments are and where to take your clients, they're not all on the MLS, folks. If you're listening to this podcast, you need to know where the subdivisions are. They pay well, they make it easy on you, they have inventory, get it done. Don't sleep on new construction in 2022. All right, as a recap, 16,665 units, or 4% increase in the market in terms of units. 3% decrease in volume, but still 3% increase in volume to close out at $5 billion. To hit my prediction of 21 just a year late. 6% increase in prices to $300K average, which also could be said as a 6% price appreciation. RPP. My folks here within these four walls going to go 1,800 units for $500 mil, $275K average, 10% share, or 5x the production of the average agent in the market. Interest rates are going to flirt with 4.25%, but settle around 4%, with about just over a half point increase from today's rates, behind 5 Fed rate hikes and 1 more market shock. Number 4, absorption rate will drop as low as 3/4 of 1 month. Sub 1 month inventory. Sub 1 month inventory at some point in 2022. The Dow's going to go 35K or flat on the year. It may oscillate between now and then. 70K for Bitcoin, 1,300 for Tesla, or a 27.8% increase. 1,600 new construction sales for last year will become 2,500 this year, or 15% of the market, up from just shy of 10. Those are my predictions. Mark them down. Lead pipe locks. If you're into sports betting or cheesy sports betting radio, I hope these come true. I'm going to leave you with one final thought. A different market is not a bad market. We've been very fortunate. We've been on a 11 or 12-year run of hot markets. Okay? No matter what team you're on, red, blue, right, left, everyone likes housing. Everyone likes your home to be worth more this year than it was last year. The levers, or the hands that pull the levers of, that change policy in our government, want you to be successful. If the market goes sour, it will be because they couldn't possibly keep it positive. And every peak has an equal and opposite trough. Don't expect the market to be good forever. I repeat, don't expect the market to be good forever. It will retreat at some point. But you can make up for a smaller market with being more efficient. My team got 75% of their 26 offers they wrote last week under contract. If you compare that to 50%, then there can be 25% less inventory and we have the same production. A different market isn't a bad market. Mark it down. All right. Thank you guys so much for tuning in. Once again, find us on anywhere you podcast, but specifically Apple, iTunes. Give us a follow and a 5-star. Spotify also is another point of inflection for us. We'd love to grow our following there. Find us on all the socials at JTPA Louisville on Twitter, at J_Pitts on TikTok, at JPitts Realtor on Instagram. Facebook.com/The Resource Podcast for links and show clips. Full episodes on YouTube.com/JPitts Realtor. We'll be back and see you real soon. Once again, I am your host, Jay Pitts, broker owner, REMAX Premier Properties, host of Resource Louisville. We'll see you soon.